Alright guys, welcome back. We're taking a look at another one of my corporate finance problems that I also believe will be on my exam. This one is a expansion project analysis, and as you can see, we're dealing with a lot more words and a lot more numbers than we were before. So the way we tackle one of these problems is we just start with the first thing we need to know and we move on from there. And according to this, the first thing we need to know is the initial outlay. And the initial outlay is also synonymous with CF0, or the initial cost to start the project. Now, to calculate initial outlay, first thing we want to do is we want to get a little calculator here, and we want to clear everything, compute clear it all. And now we're going to be looking at what the initial cost of starting up the project or expanding the project, because we're buying a new plant, is. And the first one is the $28,900. That is the cost of the existing building. So 28,900. Let me move this over here. All right, and then we're going to add that to the cost of equipment for the plant, which is 16,100. And then the final thing that we have to add is the initial investment of net working capital, which is $15,000. So we're going to add 15,000, and we know that our initial outlay is a total of $60,000. Go over here, go $60,000. Easy. Okay, now it gets to the harder part. The harder part is figuring out our cash flows for each year. Previously, the question had the cash flows already calculated for us. This time around, we have to calculate the cash flows ourselves. So let's take a look. We know that annual sales is $107,700, and that we know that the variable manufacturing cost for those sales is 65% of the total sales. And we also know that there's a fixed overhead cost of $10,300 a year, as well as we have to pay the tax rate, federal tax rate of 35%. Okay, so good news is once we figure out the total sales after tax for year one, we'll have that for year 2, year 3, year 4, since these are all fixed numbers that don't change year over year. So let's just start with that. Let's take it back out the calculator. Let's go and figure out what we need to. So how we tackle this problem is we figure out what our total cost is. All right. So we know that we have $107,700 worth of sales every year, and we know that 65% of those sales are going to be expended off as cost. So that means we multiply it by 0.65, and that's our total cost of sales for each year. And then we just add the fixed overhead costs, which are $10,300 every year, to that number, 10,300. And we know that our total cost for that year is $80,305. So we're going to store this in 1. And storing in 1 means that this number is locked in this 1 button. And we can recall it using the recall function here anytime that we want. So we have it stored in 1. Now we're going to go back and type in our $107,700. And we're going to subtract it by the recall 1, which is our total cost for that year. And we're going to get a net income before tax of $27,395. And now what we have to do is we have to multiply that by the tax rate. And since we want to know how much we're actually saving, it's 1 minus the tax rate. And the tax rate being 35%, 1 minus 35 is 65. Putting that in terms of a percent is 0.65. So we're going to multiply this by 0.65. And we know for every year, our net income before depreciation is $17,806.75. So we're going to store that in 1. That's not changing. We're going to use that very often. We want to keep that in a back pocket. But we still have to add on depreciation. So depreciation is done on both the building and on the equipment costs, or in the equipment cost. But thankfully, they have depreciation already figured out for us in year 1, year 2, year 3, and year 4. So all we have to do, very simple, is take depreciation year 1, 3,931, and we multiply that by the tax rate, which is 0.35. And then we just add this back to our stored 1 value. Ooh, I just stored it in 1. God, that's not fun at all. That is not fun at all. But thankfully speaking, I think I can come back and remember. Well, it's pretty easy to go back and fix, to be honest. So all we have to do is clear this and go back. I'll just do this really fast so that we don't have to worry about it. 0.65 plus 10.3, 80. We're going to store that in 1. We're going to take 107.7. Once you get through this, everything goes a lot faster. And we're calling, storing that and that. And then we're going to times by 0.65. And there. And then we're going to store this back in 1. All right, there we go. All right, now we're back to where we started after I made a mistake. Thank you. 3931 is depreciation to year 1. Multiply it by the 0.35. Boom. And we're going to add that to recall 1, not store 1, of this value. And we get 19,182.6. Well, we're going to round that up to 19,183. Now that is our total cash flow for year 1. Now, as you know, that this number right here is a fixed. So this is going to be the same for every year. So all we have to do is just calculate the depreciation expense for every year. So we know year 2 is 5,801. 5,801. Multiply that by 0.35. And we just add that to this number. And boom, 19,837.1. That is our cash flow for year 2. Oops. All right. And for year 3, our depreciation is 3,647. 3,647. Multiply that by 0.35. 1,200, 1,276. Add that to recall 1. 19,083. We're moving. It's just plugging and chugging at this point. We did all the hard math to figure out these cash flows already, and we're just moving as fast as we can. 2,458 times 0.35. Don't worry, harder math's coming down the road. Trust me. Add this to recall 1. 18,667. All right. Now that we have our cash flows for year 1 to 4 and our initial outlay, we have to find the terminal non-operating cash flow. So at the end of the life expectancy of this project, we sell off all of our assets, and we take in the last year's cash flow, which is cash flow year 4, and that is our total cash flow for the final year. So we already have the cash flow year 4. We know that, but we need to now figure out what the value of our assets are when we sell them. So to figure this out, and this is the most complicated part of the whole question. Is first we want to we have to take and if you read right here, it'll tell us at the end of that time, at the end of the 4-year life, the building has a market value of $25,432 and a book value of $26,426, whereas the equipment expected to have a market value of $3,059 and a book value of $2,737. That's the important information that we didn't look at that is going to be playing into this terminal non-operating cash flow. So the first part about figuring out terminal non-operating cash flow for this problem is we have to find the salvage value, the value of our assets at the end of the 4 years. Now, the salvage value is going to be equal to the market value of the building plus the market value of the equipment, right? $25,432 plus $3,059, and then add the net working capital that we get back at the end of the project as well. So if we go here, $25,432 plus the market value of $3,059, and then we're going to add the $15,000 net working capital. So what we just did was we added the market value of the building plus the market value of the equipment plus the initial working capital that we get back, and we get a number of $43,491. I'm going to store that into 1 because that is important later on. And then I'm even going to go so far as to take out the net working capital, and I'm going to store that one into 2, and I'll show you why in a second, just to make it easier. Okay, so now that we have the salvage value, which is stored into our number 1 spot on our BA2+, we're going to have to go on and figure out the difference between the market value and the book value of our assets. This is why I stored 2 as well. So first of all, let's go and figure out the book value. So that's pretty easy. We just add the book value for the building, which is 26,426, to the book value of the equipment, which is 2,737, and then that's what we get. And I'm going to store this in 3. And if you remember, I saved the market values added to each other in 2 already. I did this so I could easily take this and subtract it by the book value, and then we get the difference, which is a negative 672. Now we actually have to pay tax on this number. So we'll multiply this by the same federal tax rate we've been using the entire time, 0.35, and we get a negative 235. And I'm going to store this in 7 because I like 7. It's a good number. And now we go back and we recall 1, which is our total salvage value, which is the market value for both our equipment and our building, and added to the initial investment of working capital, which is 15K. So we take this and then we subtract it from our number, which is the difference between the market and the book multiplied by the tax rate, and we get a number of 43,726. And that, my friends, is our terminal non-operating cash flow. Let me just make sure I get this. 43726. 43726. Now, what makes it difficult to do all these types of all this math is because we're using our BA2 Plus, which is the standard and most common calculator in any finance student. It'd be a lot easier to use Gravity Calculator to do some of this math, so we don't have to keep storing moving numbers around, and we could just plug all the formulas in as one without getting too complicated and easily doing it like any graphic calculator could. However, finance professors do not usually let you use other calculators besides a financial calculator like the BA2 Plus. So you got to get really used to storing numbers and recalling numbers to be able to do some of the math that would otherwise be easier on another calculator. Anyway, so now we have everything that we need to find net present value. So if you really think about it, this whole problem was just for us to figure out what CF0 was, CF1 was, CF2 was, CF3 was, and CF4 is when accounting for the salvage value of the terminal non-operating cash flow of our assets at the end of the year. So pretty easy. We go in CF0 as we found before. Just remember to put it as a negative because it is a cost that we bear in the beginning. Is 60,000 initial outlay. CO1 year cash flow in year 1 is 19,000. Oh, did that wrong? Don't worry, I didn't save it, so it's fine. 19,183. It's going for 1 year. CF2 19,837. CF3 19,083. 19,083. I say the numbers out loud in various ways to help my mind remember to plug the number in correctly, because you would think after doing all this work, one of the hardest parts to realize is that you plugged a number in wrong or used a number in wrong in some input. Okay, so, and I not thinking, I plugged in CF for cash flow of year 4 as 18,667, which is what the cash flow is. But to find the total cash flow, we have to actually add the non-operating cash flow, terminal non-operating cash flow, onto the cash flow for year 4. And since we're already in the cash flows from the BA2 Plus on the screen, I will just be doing this on my own calculator in my hands, which is the BA2 Plus as well, which is really simple because all we do is we take the 18,667 that's in the cash flow of year 4 and we add it to the terminal non-operating cash flow with 43,726, and our total is actually 62,393. Boom, easy. Okay, now that we have all of our cash flows in place, we're going to go to NPV like you guys have seen in the previous problem I did, and we're going to have to figure out the cost of capital, the I, and that is given to us at 11.3%, and let's not forget that it's already put in terms of percentage, so you can just put 11.3, and then we compute NPV, and we get 27,748.5, so 27749. 27749 is our answer, and this is completing the problem in its entirety. I hope, I know this is long. A lot of problems can be very long in finance, but I hope you guys found it educational, and I hope it helps me study. Thank you very much.